In 1913, the United States government did something that changed everything. They passed the 16th Amendment, the one that gave Congress the power to collect income tax. And every financial advisor, every accountant, every wealth manager in America will tell you that was the beginning of the modern tax system.
What they won't tell you is what else Congress put in that same tax code.
Escape hatches, legal ones. And for over 100 years, the people who wrote those laws have been quietly walking through those hatches while the rest of America lined up to pay full price. I'm not talking about loopholes in the sneaky sense. I'm talking about structures, vehicles, legal entities. There are 3 of them, because this right here is the thing the wealthy have been using since 1913, while you've been handing over 22, 24, 32% of everything you earn. 32%!
Stay with me, because the first one alone is going to make you question everything your financial advisor has ever told you.
Okay, so I need to give you a little context first, because this only makes sense when you understand one thing about how the American tax system actually works at its core.
The IRS taxes events, not wealth. Events. You earn money, mate? Taxable event. You sell a stock? Taxable event. You receive a dividend? Taxable event. You inherit above a certain threshold? Taxable event. But if none of those events happen, if your money grows inside a structure where the event technically never occurs, the IRS is sitting outside in the parking lot. They cannot come in. They have no invitation.
This is not a trick. This is not a scheme. This is literally how the code was written.
And the 3 structures I'm about to show you exploit this principle in 3 completely different ways and completely legal ways.
The first one was created in 2017, and when it passed, wealthy investors moved billions of dollars within weeks.
Billions.
And you probably heard about it once on the news, and then it disappeared from conversation entirely. That's not an accident. It's called a qualified opportunity zone.
And here's the story of how it actually works, Tad. Because the technical explanation will put you to sleep, but the real story will make your blood boil.
Picture a neighborhood. Could be anywhere in America, Fue. There are over 8,000 of these zones designated by the government. Historically low-income areas. Places that need investment, infrastructure, development. Now picture a real estate developer. Let's call him Richard.
Richard just sold a portfolio of stocks and made, let's say, $3 million in capital gains. Normally, Richard owes capital gains tax on that $3 million. Hundreds of thousands of dollars to the IRS, due within months. But Richard's accountant tells him, hold on, don't pay it yet.
Take that $3 million and invest it into a qualified opportunity zone fund within 180 days. Richard does it, and here's what happens. The capital gains tax? Deferred. Not gone, boss. Deferred.
Richard doesn't pay it until 2026 under current law. So he has years of that money working for him before he owes a single dollar. But that's just the beginning. Because if Richard holds that opportunity zone investment for at least 10 years, and this is the part they really don't want you to see, any new gains on that investment are completely tax-free, not deferred, free, gone. The IRS cannot touch the appreciation on that money if he holds it long enough. So Richard takes $3 million in taxable gains.
And walks away with potentially $10, $15, $20 million in growth that was never taxed. And the neighborhood?
Sometimes it actually gets developed. Sometimes Richard just builds luxury apartments that price out the very people the zone was supposed to help. But that's a different video. The point is hacking. This structure exists. It's legal. Most Americans have never heard of it. Okay, but wait, it gets worse. Because opportunity zones are just the entry level. That's the one they'll tell you about if you push hard enough.
The second structure, Penang, almost nobody talks about this one. And the reason they don't talk about it is because it sounds too simple. Too obvious.
It's called a self-directed IRA. And I need you to forget everything you think you know about IRAs for the next 2 minutes. Normal IRA tests. You put money in, it grows tax deferred. You invest in stocks and mutual funds that your brokerage approves. Fine. Standard. That's what they show you in the commercials. Self-directed IRA high. Same tax advantages, same IRS rules around contributions and withdrawals. But what you can invest in? Completely different. Real estate, private businesses, raw land, cryptocurrency, precious metals, tax liens, promissory notes. Literally almost anything. And here's what that means in practice. Let me tell you about a woman named Sandra. Sandra had $240,000 in a self-directed IRA. In 2014, she used that IRA to purchase a small rental property. The IRA owned the property, of this not Sandra personally. The rental income went back into the IRA, TAO, tax deferred.
The property appreciated.
Sandra sold it in 2022 for $900,000. That's $660,000 gain?
Inside the IRA.
Tax deferred. If Sandra had set it up as a Roth self-directed IRA, that gain would be tax-free entirely. She didn't sell stocks. She didn't get a salary. The IRS watched the whole thing from the parking lot.
And here's what I need you to hear, Tough. This is the one most people miss. The contribution limits for an IRA are low, a few thousand a year.
But if you have an existing retirement account from an old job, a 401k sitting somewhere doing nothing,
you can roll that into a self-directed IRA without taxes, without penalties. People are sitting on 401ks from jobs they left 5 years ago.
That money could be working inside a structure where the IRS has almost no power over its growth. I'll explain exactly how to start that process in a second. But first, Hank, the third structure. And this one is the wildest one. Because this one doesn't just defer taxes. It doesn't just make gains tax-free. This one, if you qualify, can make your entire income tax-free, legally, permanently, while you're still an American citizen. It's called Act 60, and it lives in Puerto Rico. Now, before you click off, Tyne, hear me out.
Because I know what you're thinking. I've heard it. I'm not moving to Puerto Rico. Okay, fair. But just understand what this is.
Because even if you never use it, knowing it exists tells you everything about how this country's tax system actually works. Puerto Rico is a United States territory. American citizens living there are subject to Puerto Rico's tax laws. This is written into the U.S. tax code. It has been there for decades. Act 60, CORD, passed in 2009. Move here, establish genuine residency. Operate your business or investments from here. And pay, are you ready? 4% corporate tax, 0% on capital gains, 0% on investment income, not deferred, not reduced, 0. A hedge fund manager who moves to Puerto Rico and makes $50 million in investment gains pays 0 federal income tax on those gains. Legally, completely. The IRS knows about it. Congress knows about it. They wrote the law. And here's what's been happening quietly, and then very loudly, over the last 5 years. Crypto investors, tech entrepreneurs, day traders, remote workers with high incomes. They've been moving to San Juan, Dorado, Rincon, establishing genuine residency.
Which means spending at least 183 days a year there, having a real home there, building real community ties.
And paying almost nothing in taxes. The document that proves this?
It's the Puerto Rico Incentives Code. Public record. Anyone can read it. Nobody does. So here's what the rich actually do. And here's what depending on your situation, you can actually start thinking about right now. If you have capital gains from selling a business, property, or investments plans, look into qualified opportunity zone funds before you pay that tax bill. You have 180 days from the sale. That window is real, and it closes fast. If you have an old 401k or retirement account sitting at a former employer, call a self-directed IRA custodian this week. Ask about a rollover. Understand your options. The account is yours. It should be working for you. And if you're earning significant investment income, if you're a trader, a remote entrepreneur, someone whose income is location-independent, educate yourself on Act 60. Not because you have to move, but because understanding that this option exists tells you something important about the system you're operating inside. This one thing, just this one thing, changes how you see every financial decision you make.
So let's come back to 1913, the year the income tax was born. Congress created the tax, and in the same breath,
In the same document, they built the exits. Because the people who wrote those laws knew something the rest of America didn't. They knew that the tax code was never meant to apply equally to everyone. For over 100 years, that knowledge has lived in law firms and private wealth offices. Passed down like an heirloom, like a secret, like a birthright. You now know it. The IRS isn't your enemy, Poneet. Not exactly. The IRS enforces the rules. The rules were just written by people who had already built their exits before anyone else arrived. Opportunity zones, self-directed IRAs, Act 60, 3 doors, 3 legal structures, 3 places where the IRS stands outside and watches. The wealthy don't pay less tax because they're smarter than you. They pay less tax because they were handed a map that shows where the doors are. You just got the map. What you do next, that's the only question that matters now. And next week, Hammond, I'm gonna show you something that will make even this feel like common knowledge. There are people, right now, building massive wealth using a legal structure so obscure that most CPAs have never heard of it.
It's not a trust. It's not a corporation. It's something older.
Something that was used by the Vanderbilts, the Morgans, the original American dynasties. And it's been available to everyone the entire time. That's next. Don't go anywhere.